I want to start with the war. You write that it is inflationary. I think we're all seeing that happen right now, at least when it comes to oil prices and the way that oil flows through to the rest of the economy. What's the bond market telling us about how inflationary it will be ultimately?
Yeah, what we've seen is the way we look at it, Tim, is through the tips break even rates. Now that isn't necessarily the best measure, but it is one way the bond market tells us what it's expecting. And those break even rates have moved up, particularly for shorter term tips. They're, pushing 5% or so for 1 year. So it's implying that the market is expecting an inflation rate, at least on a short-term basis, to move all the way up to as high as 5%. The longer-term break-evens are still pretty well behaved, maybe around 2.5, but they have come up. So what we've seen is the expectations about inflation move higher across all tenors, but particularly across the short-term tenors. And you can look at other measurements in terms of expectations. I think the bond market, though, is really speaking loudly right now that the big fear is inflation hitting us due to the war.
And in private markets, spreads are widening. How much of that is growth versus just really the stress in the private credit space?
Yeah, there's a combination of things going on here. So kind of coming into this, we've seen spreads were really compressed, really tight. So anything that didn't work out perfectly was probably bound to cause them to widen. I think now between the woes in the private credit area and the expectation that we're going to see some weakness in earnings amongst various companies that might be caught in this, in the after effects of the war or the downside of what the war may do, starting to widen those credit spreads. It's also probably just a general risk aversion taking place as investors just pull back. Credit spreads tend to be correlated somewhat with equities. We're seeing equities come down. I think it's just a risk aversion taking place.
Why, Kathy, do you think that Treasuries are not being viewed as a safe haven asset right now?
Yeah, it's got to be somewhat disappointing, I think, to a lot of analysts who thought perhaps we'd see a run into treasuries. But I think the primary mechanism that we're dealing with here is the inflation pressure that was already building up coming into the war from, the fiscal stimulus from the One Big Beautiful Bill and the fact that inflation's been above target, the Fed's target for 5 years now. I think that the market's not as comfortable with treasuries as a risk off right now because of those factors. And the Fed is not indicating an aggressive rate cutting cycle because it's not yet a financial market risk. But I wouldn't rule it out down the road if financial conditions tighten enough, if there's enough worries about economic growth down the road that we could see treasuries rally. I do think we're getting to valuations that discount a lot of negative news, but in terms of flight to safety, the dollar's gone up, but we haven't seen a whole lot else in terms of the treasury market.
So talk a little bit, if you could, Kathy, about what it would take for you to see investors flock to treasuries as a safe haven. Like, what financial conditions would need to tighten? What would need to change?
Well, I think it could go one of a couple ways. So on the one hand, if we had a severe enough sell-off in the stock market or in risk assets, where we started to see the potential for the Federal Reserve to come in and provide some sort of support, then I think you'd start to see treasuries rally. And again, we may not be too far from that, because if conditions tighten enough, then the economy is going to take a hit, and that would pull the Fed in. A second way that it could occur, though, is that, we do start to see the war and, these tightening conditions really, really depress expectations for economic growth. And then we'd start to see people move out on the yield curve, looking for something that would benefit from slower growth. But again, we're just not there yet.
We're seeing a bear flattening in the yield curve. What should investors take away from that signal?
Yeah, and again, this is kind of a not great signal for Treasury investors right now, the bear flattening. We've been in a steepening, which was, I think, generally, we have been, talking about the steepening for about a year or so, as the expectations were for the Fed to cut rates, but inflation to remain sticky, and that was keeping the curve steepening. You add in the rising debt levels, deficits, financing, that's happened. Now we get a little bit of a bear flattening now. I think that's more driven by all the focus on the short end and seeing those yields move up to compensate for inflation expectations.
So the Fed and where the Fed goes from here. There are a lot of questions about what the actual next move at the Federal Reserve will be, higher or lower. What do you think it'll be?
Well, I think they'll try to stay on hold as long as possible. So I think they're trying to navigate this by doing very little and saying, well, we're positioned okay for now. This thing could go one way or another. We don't want to make a mistake. And again, if the war continues and we continue to see upward pressure on prices, oil prices in particular, then barring a big decline in the economy or rise in unemployment, the Fed may actually have to pivot towards hiking rates. I don't think that's the most likely outcome, but it is now on the agenda, I would say, because of the inflation pressure and the rise in inflation expectations. So a lot's going to depend on the labor market, but I would say no change in policy for the rest of this year, barring a big surprise. And maybe we're building in the potential for a rate hike somewhere, late in the year if things continue. But it's such a highly volatile environment, both from a policy perspective and a market perspective. I think for the Fed to try to make a call now, let alone us spectators, is really difficult.
It does seem like the Fed is relatively calm about long-term inflation. Do you think that the market, though, is underestimating that risk?
Yeah, I think the Fed Chair Powell has frequently pointed to those break evens in the TIPS market as an indication that inflation expectations are well anchored. And I take a little bit of issue with that because as you go out in the TIPS market, the liquidity isn't great. And it's easy to latch on to an indicator that, maybe provides some confirmation bias for you. There has been a divergence if we look at survey-based, say, University of Michigan survey inflation expectations. Seen short run, inflation expectations rise very sharply, and then the longer run rise, but not as sharply. That may be a better reflection right now of where inflation expectations are than the break-even rates. Again, the Fed is taking comfort in those break-evens. I would say I would look to the survey-based right now, because the longer inflation stays up and goes higher, the more those expectations get built in, and the longer it's going to take to unwind them. So I think the Fed may be latching onto something that may not be as strong an indicator as they would like.
Hey, Kathy, before we let you go, I just want to take a moment to recognize the incredible career that you've had. You're stepping down, or retiring, I should say, from Charles Schwab and from the industry at the end of this month. And we're gonna talk a little bit about that. But before we do, this moment in the context of your career, it's a really complicated one, and you're sort of, I think it's fair to say, at least when it comes to the news cycle, you're going out on top. But how do you view this moment in the context of your career?
It's one of the most complicated situations I've experienced, and I've been around a while, so I've experienced a lot. All the way from the commodity markets of the late '70s, early '80s. That was crazy. The flash crashes, the big crashes in markets, the Asian currency crisis. I mean, you name it, certainly the great financial crisis. I've seen a lot. This is not as severe as some of them, because I think the economy was in decent shape coming into this. But I think from a policy driven perspective, it's one of the most complicated because it really wasn't signaled very much in advance that we were doing this. We were at a kind of pivot point in terms of trying to get inflation down. The global economy is feeling a lot of inflation pressure and was coming into this. So we've had a combination of policy issues that are hard to unwind, along with market issues that are hard to unwind. And I would say this is one of the trickier that I've seen in my career.